Figures from nationwide building societies showed that house prices are rising at an all-time high, the fastest in fact they've risen for almost 16 years. This is somewhat at odds with the wider economic turmoil that the UK is facing, and we're still in the very early stages of any seeming recovery. Plus, we are about to hit this second wave. So what's behind this apparent contradiction between house prices and the broader economy? Well, there are four main reasons that is driving the accelerated house prices. And in this drill down, I wanted to go through those four reasons. So number one, an obvious one, is pent-up demand. During lockdown, 150,000 house purchases that would have otherwise taken place had to be put on hold between March and July. Data from RICS suggests that buyers have returned to the market in much bigger numbers than sellers. So you have much more demand than you have supply, which is boosting prices and accelerating the growth there. So pent-up demand has been a big factor, but another big factor supporting that has been the government support measures. So companies so far have borrowed about 58 billion in emergency loans backed by the government. This is C-bills and bounce-back loans. That's according to the Treasury. On top of that, the job retention scheme has been instrumental in supporting jobs and wages and therefore demand. As people have been at home not working, they're still getting paid and are able to do things like go on Zoopla and find new properties. About 40 billion has been used to cover the wages of furloughed workers so far. Alongside those two measures, you have about 13.4 billion has been used to help self-employed workers. So the total for the variety of schemes from the government is over 100 billion. This is direct money pumped into people's hands, companies' bank accounts, and these individuals and companies now have a lot of short-term liquidity, and these government measures have indeed created a lot of short-term liquidity in the market. A lot of that liquidity has found its way into asset prices, whether that's stocks and shares, but definitely property as well. So you have the pent-up demand, and then you have the government schemes and support measures. We also know that there's a differential impact of lockdown on incomes. What this means is that lockdown and the pandemic has disproportionately affected people on low incomes. Low income workers, particularly those in the gig economy, have had their incomes slashed either because they can't work or their hours have been vastly reduced. And this so far has not affected people on higher incomes and people on non-gig economy type jobs, people who are able to work from home without having to sacrifice their pay. What this means is, as a result, the housing activity over the summer has been disproportionately skewed towards people on higher incomes and therefore higher value properties, which is pushing up the average house price. So people who are on lower incomes are less likely to be buying property in this type of conditions, but actually the people on higher incomes are more likely to be buying property in these conditions, and that's creating a skew in the average price. The last and probably the most obvious reason is the July stamp duty cut. So in July, the Chancellor cut stamp duty, and it's estimated that this will increase the price by about 1.2%. So the stamp duty alone will drive up prices by about 1.2%, but it also lead to about a 6% increase in the volume of transactions. This is compared to what would have happened if there was no stamp duty cut. So in summary, we have four main reasons: the pent-up demand that comes from people not being able to buy through March and June, the government measures that they've announced, which have pumped about over 100 billion in liquidity into the market, the disproportionate impact of lockdown and the virus on people on low incomes means they're less likely to be in the market for property now, whereas people on higher incomes are more likely to be in the market for property now. And finally, the stamp duty cut that the government announced in July. So all of these things have really been sort of like a rocket booster in the property world.
Is now a good time to invest in the stock market? With most global markets having recovered most of their post-pandemic losses, which sectors will recover and which ones will benefit in the new economy? Is investing in commercial real estate still an option given how much it has fallen since the start of the pandemic? Is now a good time to go into buy-to-let? Or is now a good time to buy your own home for the first time? Especially with the whole new work-from-home culture that is expected to be the norm. Either way, is it better to get into new builds or to buy existing stock? Well, get the tools, knowledge and mindset coaching that you need to build wealth by buying passive income assets that will help you get rich slowly. Join the Slow Money Investment Club.